segregation of duties, and internal controls for our investment cycle. Obviously, quite important because this is an asset, just like inventory, just like all of our accounts. Let's make sure that we have the proper controls in place. Well, how would we test the segregation of duties? We would examine the authorization of investment transactions. We would test the accuracy of the investment records, verify that all investments are adequately collateralized. If we have an investment and we need to maintain 20% cash balance based on the value of that, making sure that we actually do have that in place, reviewing the approval process for investments, that's authorization, making sure that this company can't just go and buy and sell stocks without someone signing off on it, investigating any discrepancies between the investment register and the bank statements. We say we bought a stock and we don't see the cash going out of the bank, that's a problem. Ensuring that only authorized personnel are allowed to authorize investment transactions, making sure that the just normal minimum wage, just guy who just started yesterday can't just buy and sell stocks for the company. Ensuring that if the company does not employ an independent trust agent to hold the securities, two company officials have joint control. Okay, so if basically saying if you don't have Vanguard, Fidelity doing that, and they're independent, right? If you don't have Vanguard or Fidelity holding your securities, then two officials from the company have joint control over the securities, which are kept in a bank safe deposit box, dealing with custody, making sure that one person doesn't have access to these so they could steal them. The recorded balances in the investment subsidiary ledger are periodically compared with the context of the safety deposit box or investment account by independent personnel dealing with completeness, assertion, and our custody concern, making sure that anything we say in our ledger, we're keeping track of the buys and sells for our stocks, making sure that it ties out with whatever is in the safety deposit box or investment account. Now, everything's computerized, but you can think of stocks and how the AICPA's literature is written. A lot of times you can think of stocks like physical pieces of paper held by some institution. Now we've got some examples of properly designed internal controls for the investment cycle. Establishing pre-authorization for all decisions. We kind of talked about that earlier. Now that does tie into segregation of duties as well, but it also is very much a good internal control because think about it, segregation of duties is an internal control. So this is going to encompass a lot of what we saw. Establishing a system of segregation of duties, right? Obviously pretty critical. Ensuring that all investments are made in accordance with the organization's risk tolerance. This is an important one as well because authorization could just be a yes or no. Are we doing this or are we not? But also, yeah, maybe you are properly authorized to buy and sell stock, but you're buying stock for this company that is incredibly risky. And the company says you cannot buy stock unless it meets these certain metrics, certain ratios, because they don't want to engage in risky investment decisions. Now, just to take a pause, like kind of refocus. This could be, I mean, theoretically, it could be any company. This could be a manufacturing company that does nothing but make chairs, and this manufacturing company could be buying and selling stocks. There's nothing against that. They can be doing that. Obviously, they probably won't be, but it very much could be thinking like that. Or this could be a private equity fund. This could be an investment fund, something like that, hedge fund. And we could be dealing with an entity whose sole purpose is to buy and sell shares and to deal with all of this types of activity. So we could be thinking in both cases, just to refocus a little bit there. We could also establish a system of periodic reviews of all investments. That's great. I mean, for any account, periodic reviews of any account is wonderful. Obviously, it just takes time. Establishing an internal audit process to evaluate the effectiveness of the investment cycle, having an internal audit department, again, really applicable to any cycle. Lastly, ensuring that all investment decisions are properly documented and reported. Some of these are no-brainers. I mean, just putting it in writing, yeah, is great, but definitely kind of see how making sure that you have that documentation so you can go and review, see if there's any issues later on. Diving into the existence assertion for our investments. Well, how would we verify the existence? We're going to examine the corporation's books and records and then obviously verify those items exist. What's our underlying assumption is that they're overstating this since it's an asset. We would then go and look to make sure these items actually exist. We could evaluate the associated transactions, making sure that, yeah, if you say you have 10 stocks, well, where was the purchase order for those? Where was the purchase documentation? We could confirm with third parties, such as banks and brokers who may hold the actual securities. We could review the investment contracts, agreements, and related documents to make sure that everything's in line. We could visit the locations of the financial institutions involved in the investments. Now, here's another thing. We could say that we bought, because not everything is a stock that you could just buy in the public market. They may say they have an investment in some company somewhere in some country somewhere, super vague, right? But if it's a significant enough investment, it might be worthwhile to check it out. And if it's not a real company, then that's not good. Definitely not good. If it's a company you've never heard of and you can't find anything about it online, that investment may not be real. I could say, if I'm a company, I could say, yeah, I have a $20 billion investment in an XYZ company in Guatemala, but guess what? It doesn't exist. So I'm incentivized to overstate that to make my balance sheet look better. But if it doesn't exist, that's obviously a problem. Something you'd want to investigate as an auditor. Lastly, here we could examine reports of investment activity, just tying that all around together. For completeness, we're going to examine records of the purchased securities. We're going to confirm the purchase information with the brokerage firms. We could also use analytical procedures to assess the reasonableness of recorded investment income. Now, here's an interesting point because if talking about analytical procedures, for example, if the client holds bonds at 5%, simply calculating and multiplying the bond's value, the interest rate, and the amount of time would yield the proper amount of investment income. So, using analytical procedures, you should always see about 5% of interest income compared to whatever the face value of the bonds is. And this could help you with overstatement or understatement. Thinking about that like that. It's not even that investment income might be wrong. We'll do it the other way. You could calculate this to make sure investment income is correct, right? Just look at the documentation, see that the documentation says it's 5%, make sure the investment income is correct. But then vice versa, you could say, based on this investment income, is the face value, is the overall value, the book value, the carrying value of this investment correct? Next, you can compare the securities in the bank safe deposit box or investment account with the recorded investments. And lastly, you can reconcile investment accounts to the general ledger. See here, we got a little bit of tracing going on, and we know tracing is related to completeness. Dealing with our valuation, allocation, and accuracy, we could review the appropriateness of the assumptions and methods used for valuation. There's different methods. I mean, not to get into finance or too much, but yeah, different ways you could value a stock, value an investment. Obviously, you want to make sure that those methods make sense. And then if they make sense, you also want to recalculate using your own math. In evaluating the fair value of a security, the auditor would have reservations in using the quotation of a valuator who is not independent, such as a broker who originally sold the client the security. If I am a stockbroker, a lot of times these stockbrokers get commissions. I know we have commission fee trades and everything, but think back. So, especially for an entity like a large investment firm, a stockbroker may just charge them a fee, right? It's a big entity, a lot of checks and balances going in there. So let's say they get a 2% fee, and I'm making this up. This is totally not what it would be in the industry. 2% fee for the value of the amount of stock that they move for this company. So we've got a private equity firm. In this case, they are trying to buy $1,000 worth of some private small name company stock, and they're using their broker. Now, the broker could also act, now shouldn't be, but in this case, let's say the broker is trying to act as the person valuing the stock. If the broker gets a flat 2%, they have an incentive to overstate the value of the stock. Well, they might say, this isn't actually $1,000 worth of stock, this is $3,000 worth of stock. Or they might, once they sell it for $1,000, say, oh yeah, no, I think the stock is now worth $3,000. So selling that, maybe they get 2% on the sale as well. That would be extra money in the broker's pocket. So that would be someone who's not independent. Now, an independent evaluator, this would be someone who is completely unrelated to the initial purchase and sale. You just go to them and say, hey, how much is the stock worth? They would be much more of a source to check than someone who has a vested interest in the value of the stock going up or down. So the client wants the stock to go up. The broker wants it to go up because they get a 2% fee. But let's say an independent person valuing this would not want, in theory, wouldn't really care if it was up or down. They would be able to give you a proper valuation. You could recompute amortization for available for sale securities, right? And determine whether the amortization period is reasonable. Sorry, for held to maturity securities here. You could examine the accuracy of the data used for valuation, seeing if the source documentation, if the source data is correct. You could verify fair market values of securities against published price quotations in the market. That would be great for verifying the numerical accuracy. You could verify the accuracy of any reversals or write downs of investments. So if they say they wrote down the investment because it wasn't worth as much, well, you could check into that. You could evaluate the appropriateness of any impairment losses. Test the valuation of collateral used for investments. That's collateral is tied to investments for sure. If I've got $1,000 in cash, $1,000 in investments, maybe I can take out a loan based on that, a 20% loan. So I can take out some money, making sure that we actually have the collateral to back that up. We actually have the cash to back that up. You could also examine the audited financial statements of an investee company that the audit client holds using the equity method. So tying into that financial as well. Thinking back, well, we could be buying stock in a company like Microsoft or Apple, which is easy to see the audited financial statements and easy to see the value of that on the market. But if we're buying shares in a sketchy company in Antarctica, well, a little bit of a different story there. For derivatives, let's talk about derivatives, and we could go into derivatives a bunch, but a derivative is, you could think of it like insurance. Now, we're going into this because this is a type of investment. So think of derivative like a piece of paper. Piece of paper, it is an investment itself. So it's a piece of paper. Could be an option, puts, calls. If those terms are familiar, then you're on the right track. But it derives its value from something else. So this is a piece of paper. It's a contract, and in this contract, I make it with someone else. It says if the value of, here's an apple. So it looks like a tomato. Fine, we'll go with tomatoes. If the value of if the value of a bundle of tomatoes goes up to $4 a pound, I don't know what tomatoes are worth. Just buy a store every once in a while. $4 a pound, because currently they're at $2 a pound. I get paid out in a certain amount of money. Now, this contract entitles me to a payout if the value of tomatoes goes up or if it goes down, right? Depending on how the contract is made. So that in and of itself is valuable because this contract has an end date. And let's say that's 6/1, June 1st. So before that expiration date happens, you have your two parties. You have the person who's holding this, and you have the person on the other end who's agreeing to this. Now, before that date happens, you could sell this contract to someone else, and then they're entitled to the possible profits or losses from the increase or decrease in the price of tomatoes. So you see, this derivative contract in and of itself is nothing. It's just a piece of paper. The tomatoes could be an asset, or the stocks that this is tied to are an asset. I mean, yes, this is an asset as well, but this derives its value from something else. If the tomato or the stock that it's tied to does not exist, well, then this doesn't exist either. So that's a derivative. Now, when the client engages in transactions involving derivatives, the auditor needs to develop an understanding of all of these items. Again, this is going to be something where airlines will enter into derivative contracts because, like, for operational purposes, they want to enter into contracts for barrels of oil because guess what? They use jet fuel. Jet fuel can get expensive, and they're not trying to make money particularly off these derivatives. I mean, yeah, sure, anyone would love to make money off of derivatives, but airlines' end goal is to just be able to survive and pay the same price for oil. So they could, quote unquote, lock in the price of oil, just like with medical insurance, you, quote unquote, lock in the price of healthcare, and with auto insurance, you lock in the price of any damages that could happen, and it's insurance against the price of oil going up. So car insurance is basically a derivative. It's insurance against the value of your car going down, which the value of your car would go down if you crash it into a wall. So that's the same sort of concept here. This is the piece of paper. Here's a barrel of oil, and the airline is going to buy a derivative that the value of the derivative, the value of the piece of paper, goes up if the price of oil goes up. Because guess what happens? Then they can sell this piece of paper for more money, and they can buy the more expensive oil. And in theory, they didn't really make a gain or loss. The value of this paper went up, and this barrel of oil went up, and they can just keep operating their airlines. Now, there are companies like hedge funds and trading firms that will use derivatives to try to make money off of them, and solely that's their purpose. They're not using it for insurance. There's no good reason, no bad reason to use derivatives. I'm not here to give you financial advice on what to do, but just giving you an example of both ends of the spectrum where you can use derivatives for really operational procedures to make sure that your company can continue on, or you're just trying to make money off of it. There we go. We're talking about that a little bit more. Now, in auditor, these are generally more complex. We talk about these in the sense of audit risk, how when a company engages in derivatives, it is up to the auditor to assess the inherent risk. Inherent risk is going to be higher because these are more complex. Just generally speaking, you can be incredibly smart. I'm sure a lot of you smart people out there, you understand these. But in general, the inherent risk goes up when there are derivatives, when there are complex stock transactions going on. Now, the auditor needs to develop an understanding of the economic substance of each derivative. And what is this referring to? Well, it refers to the underlying reality, purpose, and effects of a transaction or event. So understanding that it's tied to the value of a barrel of oil, tied to the value of tomatoes, tied to the value of another stock. The legal form or structure, it's a concept to determine how a transaction should be reported based on true economic impacts and implications. For example, if a company buys a piece of equipment and takes out a loan to finance the purchase because they don't have the cash up front or they don't want to use that cash up front, the economic substance of the transaction is that the company has acquired an asset. The legal form of the transaction is that the company has borrowed money. That's an interesting point there. You want to understand as an auditor, what's happening? Well, really, you did this to acquire an asset, but in essence, you also borrowed money, understanding the impacts that has on the audit, the impacts it has on the financial statements. as an auditor, yeah, you definitely want to understand that because that's going to tie in, help you with your analytical procedures and help you to ensure that the financial statements are properly presented. You also want to understand the reasonableness and the appropriateness of the assumptions that were used. Obviously, that's quite important, making sure that any assumptions here, any estimates, they're going to be properly valued. Market variables and valuation methods, making sure they all tie out. The gap treatment of such transactions, which require the transactions and events to be reported in accordance with their economic substance. So, right here, the economic substance is that it has acquired an asset. You want to make sure that everything's appropriately presented according to gap. Not going to get into that too much. Obviously, that's much more of a financial accounting concept, and we're just auditing that. The data used by management to arrive at the fair value of the contract, the source data for sure should be verified. And then lastly, the derivatives exposure to risk and the possible need to recognize losses on reductions in their fair values. Now, in theory, in all perfect world, you would just say, okay, if the price of a barrel of oil goes up from $2 to $4, I get a payout of $100 to help with that. So that would be something that goes on here. Obviously, there's a party on the other end that's betting against you, and they would benefit if the price goes down. So you're just betting. I mean, it's not always that case. We're not always going to have, people. It's not malicious. It's just business. It's just someone on the other end of the contract might benefit if the value goes down. So in this case, but if the price of the oil goes down, well, guess what? The value of this derivative is going to go down as well. So if the value of the contract goes down, you want to make sure that any appropriate losses are taken. Unfortunately, sometimes things don't work out. You got to recognize those losses. Rights and obligations. Now, we just took a big deviation for derivatives, but that does come up on the exam, so I wanted to make sure you are familiar. We are going back to let's think normal traditional investments, which derivatives are an investment, so just something to keep in mind there. Now, what's one of the best things we could do to test the rights and obligations of investments? Well, just really confirm with the outside agent, whoever's holding those securities, that they are in the client's name, that there's no contingencies with them. You're really just confirming that there's no rights or obligations issues. That's really just the main thing, just confirming with that third party. Now, cutoff. We are seeing cutoff. We're diving through this. The cutoff assertion is used to ensure that transactions are recorded in the proper period. We see the definitions of the other ones. Feel free to read through here. The cutoff assertion is closely related to the completeness and occurrence assertions, so in the proper period, whereas the completeness assertion is that all transactions are recorded in the accounting records. So very similar, but different, making sure that everything's recorded, but this isn't worried about in the proper period. Cutoff is worried about the proper period. An occurrence is that worried that all transactions and events that have occurred have been properly recorded, making sure we understand the differences there. It'd help you between the difference between the 74 and the 75 getting past this exam. How would you test the cutoff for investments? Well, you could examine the timing of making and recording the investments, see if there's any issues in that process. You could confirm that investments are recorded in the correct period, verify that investments are recorded at the correct amount, verifying that the accuracy of journal entries is secure, and then electronically accessing the details of dividend records on the internet to see when the dividends were declared and paid out to ensure recognition in the proper period. Dealing with revenue recognition here, making sure that, okay, dividends, were declared, but then they weren't paid out. When do you want to recognize that? Dealing with the accrual basis accounting, making sure we have the proper period. Talking about the presentation and classification, presentation and disclosure for our investments. Well, the understandability relates to ensuring that information has been appropriately presented and is clearly understandable. Classification, we've got these proper categories such as short-term and long-term. How are we going to test this here? We're going to verify the accuracy of the presentation of the investments in the financial statements. Is it trading security available for sale, held to maturity? Ensuring investments are properly classified. Evaluating the disclosure of significant investments in the notes. If you've got $1,000 invested in one company, that's probably not a significant investment. However, if the entity has invested $10 million in another company, that may be something you are legally required to disclose. Reviewing the securities that were purchased and sold. Lastly, verifying that transfers of securities just before and just after year end have been properly recorded and classified. You may have to, at the end of the year, reclassify securities from a held to maturity to a trading security available for sale. That's a concept you may have to. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.